Good morning, student. Today is 23rd May 2020 and this is my lecture number 6A. Today I am going to describe basic accounting term. Basic accounting terms. Basic accounting terms, which are daily used in the business world. Before recording the transactions in the books, it is essential to understand these terms, as these terms have their specific meaning in accounting. These basic terms are called accounting terminology. So, first term is here, business transactions. Business transaction. Business transaction is an economic activity of the business that changes its financial position. Whenever any business transaction takes place, it results in change in the value of some of the assets, liabilities, or capital. Its feature may be it involves an economic activity. For example, when goods are purchased or sold for cash or on credit, or when salary are paid to employee, or when interest is paid on money borrowed from the bank, a business transaction takes place. Social activities are not considered as transaction. For example, if X purchases a gift for his friend, it will not be considered as a transaction because it is a social engagement. Another feature is transaction may be classified into two types, external transaction and internal transaction. External transaction involve economic activity, and internal transaction are those economic activities that take place entirely within one business entity, such as depreciation charge on fixed assets. It results in a change in financial position of the firm. So these are called business transaction. Simply we can say goods purchased from Ram on credit. This is a business transaction. Now Second point is event. An event is the result of transaction. For example, Ram started a business with capital of 5 lakh rupees. He purchased goods for 4 lakh for cash and sell 3/4 of these goods for 3,80,000. He also pays 20,000 as rent of godown. So, on the basis of transaction, event will be computed as in form of profit. Event will be computed as in form of closing inventory, cash balance and capital, etc. Now third point is account. In actual practice, the individual transaction of like nature are recorded, added and subtracted at one place. Such place is termed as an account. In simple word, we can say that when transactions are recorded at one place, similar nature transactions are recorded at one place is known as account. For example, we are purchasing medicine from medical store. Then all the purchase should be recorded at one place, and when I will calculate total of purchase price will known as account. Therefore, salary paid to employee and all the salary totaled, then it will calculated easily how much salary paid during the year to employee. An account is a ledger record in a summarized form of all the transactions that have place with a particular person or things specified. The account has divided two sides. First is DR side and second is CR side. DR side means debit side and CR side means credit side. There are two sides. In right hand side is called credit side and left hand side is called debit side. Now Fourth point is capital. Simple meaning of capital is amount invested by the proprietor in a business enterprise. Amount may be in the form of cash, goods, or assets. It is the amount with the help of which goods and assets are purchased in the business. Such as in order to calculate the amount of capital, all the assets are added up and liability are deducted out of it. So formula may be capital equal to assets minus liabilities. Assets minus liabilities. Fifth point is drawing. Drawing means when owner of business withdrew some goods and cash for personal use from business, this point is known as drawing. I repeat again, when owner of the business withdrew cash and goods from business for personal use is known as drawing. It can be said private use, household use, and domestic use. So this is called drawing. Next point is liability. Liability. It refers the amount which the firm owes to outsiders. In the word of Miller, liability are debt, they are amounts owed to creditor. This can be expressed as liability equal to assets minus capital. Thus, when a firm purchases goods on credit from A, the amount owing to A is a liability. When we have to pay bank loan to bank, these are the liability. When any amount pay to any person, it will be our liability. There are many types of liability: current liability and non-current liability. Current liability are those liability which is normally paid within 1 year. Current liability in 1 year, 1 year. And non-current liability. Non-current liability normally paid after 1 year. For example, long-term loan and debenture, etc. Now, next point is assets. Non-current liability after 1 year. Assets: anything which is in the possession or in the property of a business enterprises, include the amounts due to it from other, is called assets. In other words, anything which will enable a business enterprises to get cash or benefit in the future is an assets. Which support the business is called assets. For example, cash, bank balance, stock, furniture, machinery, land and building, bills receivable, debtors are all assets. Assets are also divided into two parts. First, non-current assets. Non-current assets. Non-current assets have two types. First is tangible and second is intangible. Tangible and intangible. Non-current assets are those assets which are held for continued use in the business for the purpose of producing goods or services and are not meant for sale. For example, land and building, plant and machinery, computer, motor vehicle, furniture, etc. are the best example of non-current assets which are not sold in business, which are support to earn profit and smoothly running for business. There are two types of non-current assets. First is tangible. Tangible means which can be seen and touched. In other words, which have a physical existence, such as land and building, plant and machinery, cash, computer, etc. are the tangible assets. But intangible assets are those assets which cannot be seen and touched. For example, goodwill of the firm, trademark, copyright, computer software, prepaid expenses are the example of intangible assets. Now, second is current assets. Current assets are those assets which are meant for sale or which are the management would want to convert into cash within 1 year. Just it is current liability. Current assets is for sold in business and convert into cash and within a year. For example, we can say debtor, stock, cash, etc. are always fluctuated, going in, going out and coming in business. So these are current assets. Now next point is now capital receipts and revenue receipts. It is also necessary to make a proper distinction between capital receipt and revenue receipts, because the revenue receipts are shown on the credit side of trading and profit and loss account, whereas the capital receipt shown in the balance sheet either as increase in liability or as reduction in the value of assets. Capital receipts. Example of capital receipt are when amount received from sale of fixed asset or investment, capital contributed by proprietor, partners, or money obtained from issue of share and debenture in case of company, amount received by the way of loan from bank, etc. are the example of capital receipt. Money obtained from sale of goods will be revenue receipt. Commission and fee received for service rendered, interest and dividend received on investment will be revenue receipt. It means we can say amount received on daily basis, regular basis of normal course of time from business is known as revenue receipt. Next point is expenditure. Expenditure. Any disbursement of cash or transfer of property or incurring a liability for the purpose of acquiring assets, goods, or service is called expenditure. It means that any type of payment for the receipt of a benefit is termed as expenditure. There are three categories of expenditure. First is capital expenditure. Second is revenue expenditure. And third is deferred revenue expenditure. Now, what is capital expenditure? Any expenditure which incurred in acquiring or increasing the value of fixed asset is termed as capital expenditure. For example, when we purchase building, plant, machinery, furniture, etc. are called capital expenditure. Second point is revenue expenditure. Any expenditure the full benefit of which is received during the accounting period is termed as revenue expenditure, such as cost of goods sold, salary paid, rent paid, electricity charges paid, etc. are called revenue expenditure. Difference between capital and revenue expenditure may be: capital expenditure is for the purpose of increasing the earning capacity of business, whereas revenue expenditure is incurred for maintenance of earning capacity of business. Next point is deferred revenue expenditure. Deferred revenue expenditure are revenue in nature, but the benefit of which is likely to be derived over a number of years. Such expenditure are termed as revenue expenditure. The benefit of such an expenditure generally lasts between 3 to 7 years. As such, the whole of such expenditure is not debited to profit and loss account of current year, but spread over the year for which the benefit is likely to last. For example, a firm spent a huge amount of 2 lakh on advertising to introduce a new product in the market, and it is estimated that its benefit will last 4 years. In this case, 50,000 will be charged to the profit and loss account of each year for 4 consecutive years. So, this type of expenditure is known as deferred revenue expenditure. Now, thank you. I will meet with some other basic accounting term in new video. It will be lecture number 7A. Thank you very much.